Okay, so really quick, looking at NASDAQ, given that it was, many moons ago, even though it was last Thursday, how were we early in the trade? So we already knew coming over London that we had London high, we were hitting buy side, and the fact that we're hitting that, everyone's going to buy super high. People are also going to buy this by force, that are forced to literally hit their buy stop because they're selling short on this down move here. They have their stop loss. Here's the safest spot, so it's kind of the last spot that people would be that are short near term. And so being bullish with kind of the underlying that we had already from this down move here, and we were still targeting this high up here, the weekly open. And again, we were already making our turtle soups on the way, which set the narrative as well. So knowing that we were looking for higher prices, and this move down here, I was buying in anticipation of hitting this, hitting the order step here, and then continuing higher. Now, the way that it was early, in the sense that it was wrong for doing so, was mainly for a couple rules. I thought about keeping them hidden, but it's really not for that matter. The first one is the idea of the FVG and the continuation. So you have an imbalance here on this candle. Assume you're going to get a new low with it. And also the up close candles, as I was essentially buying this hammer here, and then also just this low here is breaking. So the overall drawdown wasn't terrible. But there was no bullish PD array that was being presented. You're just buying turtle soups, you're just buying random lows, which you can argue that smart money is buying that. However, the only caveat with that is, well, smart money may be buying that because they have so many orders. If it's not the smart money reversal, you have to essentially get hit with drawdown first. So even though smart money is buying this low here because they need to, because they have so many orders, and they're buying this here, the actual PDAs at the given time, when none of them were broken. I didn't see this at the time, admittedly, but the buy side to buy side retracement here, so coming up to the up close candle, this up close candle traded up into this up close candle, so there was no actual bearish arrays that were being broken yet. And that was the sense that it was early. You're buying this in anticipation for them to be broken, but they weren't actually broken yet. Also, just down close highs for that matter. Because again, even though you come down here and then you buy this back up, and everybody in retail wants to buy this thinking, now, hey, this was the stop out that got people out. I'm now safe to buy this. I'm going to put my stop loss underneath here. Especially when this candle prints and looks all the way super bullish, it's going to look enticing to some. And the last or the safest spot to put their stop loss is all the way at the bottom. So when they do that and then it starts to stall, the idea is the people that did buy this are now getting dragged out and continually essentially dragged out of their position. Because even if you tried to hold, say, this and this like I had, and then you hold this in anticipation trying to get break even or a new high in that matter, you're basically dragged out of your position on this down move here. And again, we didn't have any actual up close candles being broken until this point here, which is we had our market structure shift at the bottom. You turtle soup this high, technically. Failure swing gets swept, goes to make a new low, all fine and dandy, and then that turtle soup was now broken. So that is your actual market structure shift. You also have a bullish turtle soup at the bottom as well. And not even that, if you just look at the candles in terms of what's being broken, your up close candles finally have been broken, and they're broken violently. So it went through a lot all at once. Now granted, you could have argued that, this one up here still held, but what's nice about using turtle soups is as you can essentially use them to trail your orders, and not even your orders, but the net position that money is trying to move in. They're only going to stop out shorts to go short. So when they disregard that initial or that previous short position, it's likely intending that they're trying to take it the other direction. And again, people already tried to buy this and they were getting dragged out. So you have longs that tried to buy this 3, 4, 5 times. They're all dragged out. And people are been selling this the entire time as well in anticipation of a new low. So you got to remember that you have both parties essentially coming in to fill your longs. You have the previous longs that were getting dragged out. Those will convert to longs for smart money. And then as price is literally moving down, people will chase it and they will sell it. And smart money is buying those sell orders from the people that are just chasing it down. So both parties are getting basically funneled into longs for them. And we then got our actual, move that we were looking for and everything. And we even talked about this in the Discord. Once this sync happened, this was just a buy up. This was literally just a sync down to buy up more to keep going. So while it definitely would have scared a lot of people out of their position that have been buying it, and then to get to your, your OTE, because your OTE is meant to scare people, essentially. That's to get anyone that was chasing this out, because they're going to buy this, get hit with immediate drawdown, and be scared to hold it. Not that you should have bought it up there in the first place, but anyone that did, because there was up close candles, so somebody did buy it there. When it gets dragged through like that, most people are going to exit. Or most people are just going to have a underlying stop loss of some sort, just going to get triggered anyways. So, but again, we knew prior to that happening that this was actually just a move down to continue higher, just like we already had the 2 previous days, and then just the AM session anyways, making that exact same type of move underneath the lows and then breaking. The bullish premise was never broken. Now you could argue that, you break these down close and you switch, market structure, what have you, but in reality, you really are just coming down to retrace into a BISI in discount, because turtle swirl. And then you also do some turtle soups here. You're stopping out lows. You only stop out lows to go long. You never stop out lows to go short. So if they're stopping out longs, they're doing it in anticipation to go long. And even if you wanted to play the candle body game, your down close candles are getting broke here, as well as your down close candles here are now also turning into support for higher prices. So your bullish PD arrays are now holding after a thick down close candle at the bottom of a rally, essentially. This term, the rally being the down move, into an FEG with your entire narrative being bullish already. You're looking for bullish PDAs to take. And again, you coming all the way up here just to basically sink back down is the same thing. It's the same thing as this. You're just going into an order block instead of an FEG / down close candle. And as now that we've been through some days, you can see that it did end up pushing higher and higher until Friday, and then we did it all over again, comically. So honestly, this week has been kind of shifting to the market review and future. This has just been copy paste essentially. It's kind of comical what they've been doing. Last week, run it down Monday, trade to the other side of the range, and then this case Sunday, same thing. Run it down, run it to the end of the range. We're still bullish again. Same premise, essentially, as before. Your bullish PD arrays are not breaking, so in that case, you want to keep pushing price higher. Nothing's being broken. Lows sweeping, rocketing, pushing up. Sure, that's just to bait longs to chase it. Longs that chase it up here, stop loss can be, underneath trend line or whatever the case may be, or even just people that do sell this down on a trend line break, they're immediately trapped down here just to rally against them to continue higher. So again, people are chasing the short bottom of a rally. They're trapped. Longs that bought the top are also just in massive drawdown that they're very inclined or enticed to exit, because they think it's going to fall off a cliff, and then it rallies against all of them. And even in the delivery on Tuesday, you can see you're going to stop out longs to go long. You have a couple failure swings here. You sweep those out to continue higher, or you sweep out previous candles to continue higher. In this case, you get an FEG into an order block to, of course, continue higher. They copy paste Tuesday again / today. You set some highs, start your retracement. You, of course, yes, you get your FEG and your actual, this is true bearish delivery here, 100%. Bearish order blocks holding in terms of up close candles, your SIBIs or your bearish FEGs holding. This is 100% CSD down, and it should not be seen as anything else. What's the most important is when that shifts and that line in the sand is broken. If these are all turtle soups, these are all spots that should not be touched if you're looking for continuous bearish movement. So when those are hit, and again, you apply the same logic as well, thick down close candle, end of the rally, throw a turtle soup at the bottom, throw a bonus one here, while hitting this previous order block already, is really what the market wanted to retrace to. And not even that, if you wait for this reversal to occur, look for the bullish turtle soups after. If you get a small FEG here, you sweep it, you're continuing again, and then you had your 10 a.m. ISM services, You're again sweeping failure swings to then close back in the range, and of course continue higher. And then FVG again, continuing higher, and that's kind of where we're at right now after the market closed. But those are the things that you want to be looking for on essentially whatever time frame you're trading. You know, if you're trading intraday, you want to be 30-minute, 1 hour, 2 hour. Look for those turtle soups, those FVGs, those up and down close candles, and trade those. If you're trading, you know, larger time frames, weekly, monthly, it's the same logic. Also, that monthly looks like comedy now that we're looking at it, but you guys get the idea. If you're going to be bullish, up close lows should not be closed below. And if they do, there's your, again, something like this, up close candle, close below, start your bearish movement, bearish turtle soup, bearish turtle soup. But again, understanding that this is just for a retracement lower to eventually continue higher. You don't necessarily will know if it's a full-on reversal or a retracement, and you have to use other things to determine that, because the actual down move itself is going to look nearly identical, or at least it's going to copy paste itself in terms of using bearish PD arrays. So this down move here, retracement, this down move here, retracement. And then you'll have some that are reversals, what have you. This down move ended up being quote unquote a reversal, even though, yes, it ended up retracing. They're going to look the same. You have to use other clues to figure out how far they're trying to go, or if they're trying to turn around and continue, or like I said, reverse, for that matter. So, but same logic, if you're going to be bullish, up close candles lows should not be closed below, and it didn't happen a single candle, even on the 30-minute, for that matter, if you want to be generous again, that we were looking at. Yes, it sweeps below it, but that's totally fine. Look where it closes. Wicks do the damage, bodies tell the story, all that jazz. So you not closing essentially below any up close low. And again, when I'm referring to closing, I'm saying the entire candle closing below, like under the wick. It can wick below this all it wants if it closes back in the range, or even above it for that matter. It's much more likely that was just a stop out on a smaller time frame. Which, if we go to the 3-minute, or like our intraday, on our news release and market open, market shot up, baited everybody long, crashes against them, people chase it short, thinking it's a reversal, and longs that basically bought this top get retraced out, or some of them even got stopped out for that matter. So, and even on the super small time frame, like the 1 minute, after this happened, the exact same fractal occurred. You get these monster push ups where people want to buy it, they buy the top, it retraces against them heavily, and even potentially stopping them out, depending on where they put their stop loss, just to, again, stop out longs, like on these candles here, these 1 minute candles, stopping out longs to go long. So you're going to OTE people out that are scared, that bought the top on drawdown, and then you're going to stop out people that tried to buy it, what have you, and everything like that. So, and again, you already had that premise of essentially a shuffle in price, in which if you touch the shuffle, you're not allowed to touch the shuffle, and that's the whole point. The shuffle either has to act as support off itself and basically not touch any of it. If you touch any of it, it's essentially going to die. So I will leave you with that one, but that's a whole other video for sure. But I do appreciate you watching. Again, remember the turtle soups. Those are going to be your ideas as to where the market is actually trying to go to. You only stop out shorts to go short. And when that position finally shifts and your bearish turtle soup, you know, any of these for that matter, this one, or even this one if you want to get super aggressive, when that breaks and you have bullish turtle soups now going in that direction, you only stop out longs to do what? To go long. You're only stopping out longs to go long. You're only stopping out shorts to go short.